Meta announced that they were laying off considerable employees. They didn't really put a number. The stock's up 5.5%. So if we're talking about at what point some of these mega caps have hit the ultimate of pain, it may be that they're beginning to show some sign of life, only because all the people who owned the stocks and lost money, enormous amounts over the last year and a half, perhaps are out. They sold them. The NASDAQ went down about 6% last week. So at 11 times earnings or 12, whatever Meta might be, some people think it's a buy today because they're finally facing the truth, which is that they have too many employees, bloated costs, and have to do something about it, as people like Brad Geisner has said. So I take that as a positive. PayPal had a quarter that was a good quarter. It went down. The stock is up today. Now, I wish we hadn't owned these stocks over the past year, but I'm not unhappy we own them now. And at these prices, I'm willing to say I think they're cheap. I think Google's a cheap stock. It's half the multiple of some of the consumer staple stocks, selling for half of what, Alphabet sells for. So I think you have to be careful to say, oh, nobody wants to own these, or the market is going to 3,200, because the market has been trading in a range. And it's really been, 3,550 and 4,100, and it sort of bounces around. And perhaps it's been making lower lows, but who knows when the lowest of the lows is in. And if we start to see something positive on the inflation front, there could be some rally. I'm not suggesting the market's bottomed and is going straight up, but we're not in a situation that we think is, cataclysmic when it comes to recession like in 2008 or 9. And so I think it's different. We have a different environment.
That's kind of where we are. You got to be apologetic to be a little less than overtly negative.
Particularly when you're talking about Meta.
That's kind of where we are.
Yeah, Meta treated a symptom. They didn't treat the problem. The problem still is he's got a vision that goes out a decade or two. They're just going to spend and bet the entire company on. So that's a value trap to me. It is not cheap because revenues are coming down. In terms of Google, I agree it's
10
cheap.
times earnings, isn't it? Like 10, 11 times now?
But earnings are declining.
Well, that's why the multiples declined a lot.
Right, but they've also said, here's where our cash is going. And then you've got the situation, as Diller said, you got one guy making a decision on the future of the company, which may not, and in fact, he thinks, won't come to pass. So you'd be off for nothing. There are other cheap stocks out there. In terms of Google, I think it's cheap, too, but I've got that Section 230 case that I mentioned that completely turned the company upside down if they come out and find them liable for speech. But more so than that, again, you can't focus on where the market or stocks came from. Okay, because that was a sugar high on free money for a decade. Those multiples were not normal multiples. You're still above what the long-term historic multiple is. Not the 10-year multiple, the longer-term multiple is. So that's why it's not cheap. And if earnings are coming down, you get other opportunities. The math's very simple that way.
Joe?
I don't know. I still look at it, and I never said the market's going to 3,200. I don't know where Carrie got that from. And I'm not saying that.
I heard Victoria and Scott say it.
I said it. UBS said 32 before 3,900.
Okay, but all I'm pointing out is you have to set the expectation, and you have to say to yourself, can the market really break out with any degree of strength above 4,000 if you're not going to get participation from the mega caps? They're just too statistically important overall to the indexes themselves. Okay, so you have to set that expectation for yourself. You have to look at the rally that you're getting right now, which is related to the election. It's a gridlock rally. It's nothing more than that. Okay, we want to get excited.
What if it's ahead of CPI also?
Okay, so the other side to CPI is look what energy is doing here in the last week or so. So you could get yourself real excited about a better than expected inflation reading, and then what's staring you in the face? $93 crude oil and natural gas above $7.
And China reopening, which is going to drive the global economy even more.
Why is the VIX?
But China's not reopening. They just came back and said COVID zero.
I'm not saying now, Victoria. I'm saying it eventually will reopen. And just as just as the economy's turning over, you'll have them buying aluminum ore. You'll have them buying everything.
Why is the VIX at 25, a little under 25, Steve?
I just don't think the VIX has been a reliable indicator of the markets for a long, long time. So that's why, But But there is some calmness in the market. Look, you know, I come in, I look at some stocks and say, maybe I should buy these now. And I look at a Honeywell, which I think is a story for the next 30 years because they're automating the industrial workplace.
Well, if not now, when? What bell is going to ring that says, okay,
there's no bell
that's
going to ring. And once again, you know, this is what I have to see. I have to see earnings expectations reset more towards where I'm at, which is 200 for next year, than still being where they are, and still people saying, well, I'm bearish. But when you look at their exposure is still pretty high.
Well, Victoria Jeffries thinks you get another 10% cut on earnings.